Hey guys, Toby Mathis here, and today we're going to talk about oil and gas, and specifically we're going to talk about why people invest in oil and gas and what are your options when it comes to oil and gas. So I'm bringing in one of my advisors, Stefan Whitwell, who I've worked with for many years, and he worked with the late great David McShane as well, somebody who is I worked with for many years, and he guides investors. He's a CFA, and he guides investors into oil and gas. So first off, welcome, Stefan.
Thank you. It's good to be here with you, Toby.
Yeah, and let's dive right on in. Why do people invest in oil and gas? Like, what are the big buttons that you see?
One of the biggest is that there's just not a lot of things out there you can invest into that'll help you, offset W-2 income. In real simple terms, if you invest $100,000 into a working interest, you will be able to deduct same year, assuming we get it funded before the end of this year, about $85,000 against your income, and specifically against allowable against W-2 income, and that's hard to find. So it's a very valuable deduction for people that are getting hammered.
Yeah. So when you're investing in oil and gas, what are you actually investing in? Is it because you're going to dig a hole and you're going to get the revenue that comes out of it, and you're trying to get a royalty? Are you leasing land? Like, what are you doing when you're doing oil and gas?
There's kind of two different ways that you can do that. Many of you might have heard about something called like a mineral interest, where people get royalty. That's great to be a source of cash flow, but you don't get the deductions. To get the deductions, you need to invest in something that's called a working interest. And that simply means that you are investing in the actual operation that is going to be drilling, pulling that oil and natural gas out, selling it in the market, and producing the revenue. And so you, instead of getting a royalty, you're getting a share of the revenue. And that's the way to participate in these, that's going to give you the most bang for the buck certainly from a tax standpoint.
Yeah. So sometimes a group of investors gets together and they may buy or lease a property, and then they lease it to an operator who goes in and digs holes and says, we're going to give you 15% of whatever comes up. And that's a royalty interest. You do not get a big fat deduction when you do that. But if you are part of the operating crew, you're part of the group that says, we're going to go dig the hole. Then there's something called intangible drilling costs, which become non-passive, even if you don't materially participate. So that's the accountant side of me coming out. And I'm just saying that, I'll paraphrase what you said. If you're somebody you've had a great year and you're thinking of strategies that can lower your taxes, oil and gas becomes very attractive, because if you invest in a working interest, then the intangible drilling costs are non-passive. And that's a real important distinction. I said some magic words there. What are intangible drilling costs, if you don't mind?
Yeah. So the real simple way to think about it is those are expenses that don't have a resale value, right? So if you buy a physical rig, although it may depreciate, it has some residual tangible value. On the other hand, service agreements where you hire a company to come in and provide drilling services, that is intangible because there's nothing for you to resell. You pay them, they provide you the service, that money is gone. And that is why the IRS allows you to then take such a large deduction. And you mentioned something interesting, Toby. I mean, in real estate, there's some terrific deductions, but you're subject to, you know, passive loss limitations. One of the really powerful things about this is that we're not subject to that. You don't need to be in energy as a full-time professional to get the benefit of that write-off offsetting your W-2 income. And that just makes it a very valued thing. And you may remember back in the 70s, the oil embargo, and the US government freaked out because we were suddenly realized how dependent we were on other people. And so this was just Congress and IRS working together to find a way to incentivize people to drill, to make sure that we have more energy independence. And what better incentive than to, give people some perks to encourage them to invest. And one of those was that really powerful ability to deduct against things, whether you're in the business full time or not.
Yeah. Now it's not automatic. Here's one of the things. There's some rules, right? You got to have
There's
intangible
always
drilling costs,
rules.
and you also have to be exposed to liability. This is the one that is cause consternation in the accounting world for a long time. You need to be a GP somehow. You need to have exposure. And so a lot of practitioners would say you invest in this stuff in your individual name, or if you're using an entity, you would own 1 or 2% in your name as a general partner and the rest of it through the entity. I'm going to leave that to Stefan if he's working with someone to decide whether or not that's important or not. Some people it's not. Some people have a bunch of passive income and they don't care if it's active, ordinary law or non-passive loss. Now, let's put this in another lens. Let's say that you're a doctor or you're a high income person, you're making $600,000-$700,000 a year and you're just getting murdered in tax. And you say, all right, they come into your office and they say, Stefan, is this something I should be looking at? What are the mechanics? What would you be looking at as a CFA in deciding whether this is appropriate? What kind of guidance would you give them?
So, a couple things. Outside of the tax benefit, one of the things that is important for you to look at is, does this deal make sense? Because, all of us want to make sure we get our money back when we invest in something. So I think it's important that, whoever you're working with is looking at the deal and there's a high degree of confidence you're going to get the money back. So there's a positive return outside of the tax benefit. Another thing to look
Can I stop you there? Hold on just for a second because I want to explore that. How do you get your money back in these deals? Is it because we're selling the oil that's coming up?
So yeah, literally what they do is, so if you invest, say this week, next week, it typically takes 9 to 12 months where they're drilling before they start getting the gas out, the oil out, and start getting checks to you. We're looking typically in the last, 3 funds have all come in less than 12 months, but within about 12 months, you should get your first check. And from that point on, these checks are typically quarterly. And, there's different funds out there that do it differently. Some will hold that working interest forever. One fund that we work with, what they do is if you invest $100,000 after you have gotten your $100,000 back from distributions, which they target about 5 years time from when those start. Once you've gotten all that money back, then what they do is they aggregate all the wells and working interest, and then they sell that to firms that do nothing but just buy already operating interests. And so you get one bigger final check and on to the next.
No, this is important because you're getting these checks quarterly. So it sounds to me like, again, let's say I'm doctor. I come in and you say, let's put $100,000 or 200 or whatever the number is into the oil and gas interest. I put 100,000 in. I might get let's say I get a $75,000 or $85,000 deduction, which is worth, in that particular case, 37 cents on the dollar, because it's offsetting your W-2 income or your 1099 income or any of your other income sources. And so I get an immediate benefit, and then I'm waiting to get cash, and then the cash starts to come. And I want to make sure people understand this, that they're going to get an income stream that's ordinary income, but you also get something called depletion. And since it's so hard to explain that, I'm just going to say you only have to pay tax on 85 cents on the dollar. So if they give you $1,000, you're only having to pay tax on 850 of it, right?
Yeah, and it's like Benjamin Franklin said, a penny saved is a penny earned. So it's not as big of a benefit as that upfront massive deduction, but it still adds up. Every $100 you get, you're only taxed on $85.
And you're getting that money. And I've seen folks that got it I still have oil interest from, I want to say 27 years ago, 28 years ago. Like they're still getting little checks. It's kind of weird. But usually they sell them off, like you said. But sometimes you're just getting this drip, 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 drip of a revenue stream. And I kind of think of it like an installment sale. Somebody comes in and you're like, hey, if we can spread the income out, but you've already made the money. You made W-2 income, or you have a job that's, or a business that's kicking a bunch of income out to you. And you're like, gosh darn it, I don't want to recognize all that income right now because I'm in the highest bracket. If you're in California or New York, you're over 50%. And you're just getting slaughtered with tax. And you're like, hey, will this spread that out? And the answer is yes. And I'm sorry, I interrupted you while you were talking about, we didn't even get past prong number 1, which is the income. What are the other factors? So that doctor's in your office.
Well,
And
another important thing to think about is these are not liquid. So, you can't sell it in year 2 or year 3 if in the way that you could shares of IBM. So that's important too. You want to make sure that clients have sufficient other sources of cash flow or liquidity that they can use for the stuff that comes up in life. Another thing that makes these really attractive is clients obviously get a huge benefit from reducing their tax paying this year, but sometimes you can combine it with a Roth conversion.
yeah.
So, then it's kind of cool because you can get the benefit. So, for example, if I have a $100,000 IRA and I invest, say, 115 or 120,000 in an energy partnership, and my deductions about 80-85% of that 120 is also 100,000. When I convert my IRA to a Roth, I'm going to generate $100,000 in taxable income. That's ordinary. That loss from the energy investment can offset that 100%.
Hmm.
Now I've got $100,000 in my Roth that I can invest proactively in something that's going to, generate earnings for me. Every single year, I get the benefit of that earnings tax free. So I love it when you can kind of combine both of those.
And by the way, that would be ripe for a royalty interest. So people always say like I'm a big fan of rents, royalties, dividends, interest, and short-term capital gains from the sale of options. That's like I love those 5 income sources. Royalties aren't bad. It's just their ordinary income when they come onto your tax return. But if they're going into an IRA, I don't care whether it's a Roth or a traditional, it's fantastic. Or a 401k, if you can get it into an exempt plan, or if you have a nonprofit, that's when you do that. But as an individual, you want that tax deduction and you want a bunch of tax relief. There's very few options, like penning a check to a charity. That'll get you there for a partial of your adjusted gross income. Energy, there's no such cap. So like if you made $1 million, you could probably wipe out a big chunk of that by doing this. If you're creating that type of, you could create loss in that year. And so when you're doing things like conversions, or you have a big bonus coming in, or you're selling something where you're worried about a monster tax hit, oil and gas becomes one of your options, and it's kind of a friend. By the way, Stefan, since we are sitting here at the end of the year, people have a pretty short window. So what does it look like if somebody comes in, and again, same situation, high income earner comes into your office and says, Stefan, I need to lower my tax bill. I'm going to get crushed this year. What are my options to invest in? What types of deals do you look at? What type of deals do you avoid? And what would you tell that individual?
So I'll tell you right now, one of the things that we avoid are situations where, anytime you have deals like this that have a tax benefit, you have to really do your homework because it attracts a lot of people that probably shouldn't be in the business. And they often hide huge, huge, huge fees up front, which means it's harder for your money to actually be put to work and to make the returns it needs for you to get your money back and get a returns. One of the things that we don't do is invest in deals that have those huge upfront fees. And by huge, I mean, I got 20 or 30% high. I mean, crazy. We prefer to see structures where the operator shares a very, very small percentage of revenue now, but they get a big boost after our clients have gotten their capital back. So after you've invested 100,000, after you've gotten that 100,000 back, then the payout becomes more generous for the operators. As I sometimes like to say, I don't mind if they get rich too. I just need to make sure our clients get to the finish line first. So that there's a lot of kind of homework on that front. But once we identify the right investments, it's also important for us to screen our clients again, make sure it's appropriate for them. Nobody should put too much into any one kind of investment, this included. So we want to make sure that people are being prudent in the amount that they're putting in. We want to make sure that they have the holding power from a liquidity standpoint. And then after that, the paperwork's pretty easy. They'll open up an account with us at Schwab, wire in the money. We get all the documents signed for them. We pre-fill out all those forms just to try to make it easier for people. We Actually, we've learned the hard way. We now have some additional staff and team members that are going to be available working through the holidays, just to make sure that people have an avenue to get some of this stuff done if they're realizing kind of late in the year that they're going to have a tax problem. So it's blocking and tackling, a lot of crossing T's and dotting your I's.
And the,
I'm sure you'd agree. I look at tax planning as it's not magic, it's math, and doing your homework.
And so, end of the year, then if I invest in one of these, then the company itself needs to have a binding contract to actually drill, right? Like there's a requirement that they put that to use pretty rapidly, right? But
Yeah, we need to
not
get ideally get going next week. We can take some stragglers after that, but the money has to be wired and received by the 28th, in order to have time to get everything done the right way, papered. And so, and that's, I know a lot of firms have kind of shut down starting next week in terms of new things like this, but,
I'll,
you know,
I'll try to get this out as quickly as possible. But if somebody wants to get a hold of you, uh, I'll put your information in the show notes, or they can put down connect me with Stefan, or better yet, I'll just type in there Stefan's info, or just anything that says connect me with Stefan, and I'll make sure that we get you over there quickly. But now let's talk about the actual return. So we invest in things not for tax reasons. They're part of the math, but we invest in things for return. And so somebody who's in a high income bracket obviously has a higher appetite for tax benefits. So if it creates a tax benefit to them, that's real gain that they get. That's money that's in their pocket. So again, let's say I invest 120 grand and I get a $100,000 deduction, that saved me $37,000 this year. So I had a nice return on that. And so long as I get my money back plus a decent return, I'm going to be ahead of the game. What is the type of return that, in your experience, that these investments actually kick off?
so there's the short answer is the ones that have more moderate risk, not crazy high risk. They're going to target a kind of a 7-8% IRR over the course of the 5-6 year investment. Our clients are not looking for a lottery check. They don't want to lose all their money, and they're not expecting to make crazy money. They just want to beat inflation, make more than they can make in the bank, and make a fair return. Sometimes clients ask us, Toby, well, what do you think about energy going forward? All these new types of energy, is it risky? Based on all the data that I've seen, although the new forms of energy are growing, they're still only about 20% of the total supply. With the demand from AI just booming, I think it's fair to say that they're going to need every source of energy, especially traditional sources, for a while. And so I think it's a good diversifier. I think it's going to continue to be very stable. And I sometimes get this question: well, what about like in COVID when energy prices went to zero? The good news is all they do is they plug the wells, wait 6 months, and energy prices will be back up. So I think it's unlikely that we would ever see a sustained period of you know uh, super low energy prices. Uh, the demand we're seeing now, all the estimates are that it's just through the roof. So I look at it as just a stable, needed part of daily life, and looking for a moderate return. And the key, I'll just one final thought on that. You want to you'd rather enter into a partnership that is paying a little bit more for their land and their interests, that is in a much more proven area,
Mm-hmm.
and to go in a more speculative area that promises much higher returns, because those are the areas where you might lose everything. And again, the goal here is earn a fair return and get a tax benefit. And so we're looking for, and I think everybody on the call should be looking for, uh, doing their homework and understanding, hey, how has the operator I'm thinking of investing with de-risked this so that I have more confidence that I'm going to get my money back? Because that's, from where I sit, that's pretty important.
Yeah, you don't want the really small ones where they're unproven. You don't want the really huge ones where they charge massive fees. You want something that's a very responsible, good operator. And by the way, if you're looking for the tax deduction, the magic words are working interest and the intangible drilling costs. And if you're not, then you're probably better off with the less risk of just getting the royalty interest and focusing on that. But if you want the deduction, it's a working interest. And if it's a working interest, you get the intangible drilling costs. And that's it. And some people are, talk about operating and non-operating. It doesn't matter. It's intangible drilling costs are deductible if you have a working interest period. And you just have to meet the I need to be at risk rule. And again, you're just making sure that you're investing in the right way. And speaking of investing in the right way, reach out to Stefan because this is what he does. And he'll point you at the projects that are closing now, that are good, and that meet the expectation. And Stefan, you're a fiduciary, right, with the CFA?
In two ways, both in my obligation as a chartered financial analyst, but also our firm is an RIA, so we're also legally required to put your interests first. So.
And just know that when you're going out there and you hear people pitching oil and gas, a lot of times it's just a promoter who has no duty to you. The reason I send people to Stefan is because he has a duty to you and not to any of the operators, not to any of the investments that he puts it in. And you need to be looking for that in your life of who is looking out for your best interests. Just word to the wise, make sure that the person you're working with is a fiduciary. CPAs, attorneys, CFAs, CFPs, those are fiduciaries. RIA, fiduciary, right? Make sure you're working with somebody who's going to put your interests before anybody else's and any commissions, things like that. It's the old adage, if you go into the butcher shop and ask the butcher what your meal prep plan should be, expect a lot of steak, right? And a lot of pork and anything else that he has to sell. But if you really want to do what's in your best interest, you go to a nutritionist, right? And they're going to look at, they don't have a dog in the fight. They're just going to tell you what's in your best interest. And so reach out to Stefan if you're interested in oil and gas. Thank you, sir, for coming in and sharing this with our guys. I'll make sure this gets out really quickly so people at the end of the year can
running
make
out
some
of
tax moves.
But great to be on. Good seeing you, Toby.
All right.